Hi, welcome to On the Investor's Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to learn about what investors are thinking about right now and how that fits in with building the right portfolio. We're only halfway through April, but it feels like a very long month already. Since April 2nd, when President Trump announced his reciprocal tariff plan, we've seen some significant portion of this plan being postponed for 90 days. However, tariff tension with China have escalated. There are exemptions for consumer electronics, but separate tariffs on semiconductors and consumer goods are expected in the next 1 to 2 months. Meanwhile, the stock market experienced a roller coaster ride in response to these policy changes. U.S. Treasury yields have risen, with a 10-year yield up over 40 basis points since Liberation Day. There are still plenty of uncertainties ahead, but it's worth taking stock of where we are right now and what this means for investors. First, President Trump and his team are determined to proceed with their policy agenda, even if it causes some pain in the market and the economy. However, this pain tolerance is not infinite. The 90-day pause in reciprocal tariffs came as U.S. Treasury yields surged. Potential pressure from Republicans in Congress is also worth watching. While the president cannot run for re-election in 2028, 220 Republican congresspeople and 22 Republican senators will still be running in 2026 during the midterm elections. A sharp downturn now could be problematic for the party to maintain its majority in either chamber. Hence, the administration cannot completely ignore the economic and market impact. While this provides some comfort that extreme tariff policies could be reversed, it does not help to reduce the uncertainty for business, both in the US and internationally, in the near term. This brings us to the second point. There's still significant uncertainties regarding tariff policies. The reciprocal tariffs only paused for 90 days, and negotiation could influence market sentiment. We're also waiting for product-specific tariffs, such as those on semiconductors, pharmaceuticals, copper, and lumber. All these uncertainties imply that companies could postpone their investment plans until there's more clarity. We've argued for some time that historically recessions were brought by mainly investment cutbacks by companies, not so much from consumption. As companies reduce their capital expenditure, they could also hire fewer people or even reduce their workforce. This in turn could lead to weaker consumption. There's no hard data at this point suggesting that this cutback is imminent, but business sentiment indicators are already weakening entering this latest round of tariff increases, and there are few reasons to expect the mood to pick up in April. Meanwhile, in inflation, there has been a welcome slowdown in price increase in March. However, this is perhaps less relevant in the face of higher tariffs. Even taking into account the 90-day pause, the 10% baseline tariff increase globally and the 145% tariff against China would have raised overall tariff rates for the US to as high as 22%. Unless this is reversed soon, a rebound in consumer prices is likely over the next 12 to 18 months. As a result, this stagflationary dynamic is putting the Fed in a difficult dilemma. This means the Fed could still maintain the status quo in policy rates in the face of more intense inflation and recessionary pressure on the other side. Most recent Fed commentary still emphasize the need to keep inflation at bay. However, once we start to see some weakness in the job market, which could come sometime in the second half of this year, the Fed's bias could shift quite quickly towards supporting growth. After all, its monetary policy tool might not be that helpful in cooling price increases coming from supply-side shocks, such as tariffs, while lower borrowing costs would help to offset weak business and consumer confidence and provide some protection towards growth. Another challenge for the Fed is to maintain the market perception of policy independence and not being pressured by the administration into cutting rates. This means it would need solid evidence of growth deceleration, especially from the job market, which could push the first cut into the second half of 2025. Now, with all this in mind, what should investors do? We expect market volatility to remain high in the months ahead. This is brought on by the combination of spontaneous policy-making style of the Trump administration and also the recession risk in the US as well as globally. This calls for a well-diversified portfolio, both geographically and also across different asset classes. It's worth stressing that volatility will eventually pass, and we return to our first observation that the Trump administration is not going to ignore market pain and the threat of recession, which eventually mean a stock bond portfolio should continue to outperform cash. Now, we have emphasized the role of income since the start of the year, and this is more important than ever. Whether from fixed income, alternative assets such as transportations and infrastructure, or from option overlay strategies. Investors will have a bias towards high quality assets for now. In equities, this would be companies with strong pricing power and strong cash flows that can withstand tariffs and also recession threats. It also means that global government bonds and high quality corporate credits. Beyond US equities, we can also find themes in markets where local governments could be stepping up in spending. China is a clear candidate as Beijing looks to deploy more fiscal policy to offset the impact from the current trade tension. The euro area is also under pressure to boost its military spending, which has already lifted some industrial companies connected to the defense sector. Overall, this is a time for active management instead of being passive in equity investment. Thanks for listening. If you enjoyed this podcast, please share this with your friends and colleagues and also consider subscribing. If you have any topics that you'd like us to cover, please reach out to your JP Morgan Asset Management client representatives. I'm Tai Hui. I'll see you in our next episode to discuss what's on investors' minds.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.